Good morning, everybody. This is Allie over at Core Group, Director of Marketing. Just wanted to do a quick introduction. We've got Paul on the line. He's our Regional Vice President for Business Owner and Executive Solutions over at Principal. We're really fortunate to have him on the webinar today, especially for this very timely topic. If you could type your questions today into the chat box, we'll try to make sure we cover them all at the end of the presentation. And without further ado, I'll let him get started so we can stay on time and keep everybody on task. Thanks so much, Paul.
Allie, thank you so much, and good morning, everyone. As Allie mentioned, my name is Paul Sargent. I'm a Regional Vice President for Principal's Business Owner and Executive Solutions. And what I want to do with our time this morning is really talk very briefly about some of the changes that went into effect in January with the Tax Cuts and Jobs Act, and really look at where we're seeing planning opportunities and successes now that we're really 3.5 months into the new tax legislation. And the timing, quite frankly, couldn't be more perfect, with yesterday being the official deadline of tax filing days, minus a few hiccups with technology. So what I want to do today is a couple of things. I want to talk about really where the planning opportunities are, give you some very high-level talking points about what were some of the meaningful changes to the individual tax rates, to estate tax planning, as well as the corporate tax planning world. We're going to talk about really who good client profiles are, maybe some of the specific planning techniques that are being used. What I want everyone to do with the content today is start thinking about clients that you can go out and have a discussion with about some of these specific ideas. So as we're going through some of these ideas and client profiles, be sure to write down different clients that do come to mind as we're going through these different topics. And at the end of our presentation today, as follow-up, we'll be sending out a couple of different things. First, we're going to send out a copy of the presentation that we'll go through this morning, as well as 3 different pieces of material that we at Principal have put together, really outlining what some of the changes are and really more specifically where we find the planning opportunities in light of all the changes with the Tax Cuts and Jobs Act. So where I always like to start is, where's the opportunity for your practice? What's unique about Principal is we are a business insurance focused carrier. 60% of our life insurance production is directly tied to the business insurance marketplace. So what I wanted to do is showcase kind of where we see the revenue opportunities. We're looking at these various solutions to your practice. So if I look at the last couple of years of business planning solutions, kind of our core of what we see typically done, you'll see buy, sell, key person, the average size premiums for those cases, well into the 5-figure numbers. Keeping in mind those are predominantly term insurance sales. And then we're going to talk a lot about, simplified non-qualified planning today. There's a tremendous amount of opportunity in light of all the corporate tax changes that make a lot of these non-qualified planning techniques very attractive for business owners. So as you start to think about ways to retain, reward top talent, you look at executive bonus plans, plans for owners of S corporations and LLCs, as well as simplified versions of deferred comp. Those premium numbers tend to jump up pretty dramatically, which can be a nice little bit of revenue coming into your practice. But let's talk about really what happened. So in January, the Tax Cuts and Jobs Act went into effect. And really there was 3 core elements that we're going to talk about that were changes in light of this tax reform. We're going to talk about changes to the individual tax rate, where the opportunities are, changes to the estate tax world and where we find planning opportunities. And then we'll spend a lot of time talking about the changes to corporate tax rates and where we find meaningful insurance planning opportunities. But let's talk starting off at the individual tax bracket. And keep in mind, we have about 20 minutes of our time together today, so we're going to be very, very high level on the topics of conversation. The content that we'll send out is going to go into much more detail around all these different changes. The bottom line for the individual tax changes, there was an overall reduction of individual tax rates as well as an expansion of the tax brackets. A good example of this is a couple married filing jointly making $300,000 of adjusted gross income saw their income tax bracket go from 33% down to 24%. Those are meaningful changes that now that we're 3.5 months into fiscal 2018, those individuals are starting to see more money coming into their paychecks. Additionally, there was a doubling of the standard deduction, up to $12,000 for a single individual, $24,000 for married filing jointly. However, there was an elimination of the personal exemption. The bottom line of what we're seeing with individual tax rates is that we are seeing these continue to have a bolstering of people seeing more money in their paychecks over the first 3.5 months of this year. Tying into the individual tax rate, what's lumped into there is also the estate tax world. The biggest thing that we're finding with the estate tax world, and I hear this from advisors and clients all across the country, is that with the doubling of the exemption, there's a lot of opportunity that's been gone now because traditional estate planning is gone away. The exemption did double to $11.2 million for a single individual and $22.4 million for a couple married filing jointly, and those are indexed for inflation as well. The key thing to remember as you're sitting down with clients around any of the individual or estate tax changes, these are all temporary changes. At the end of 2025, all of these individual rate changes are going to sunset and revert back to where they were in 2017. So on January 1st of 2026, individual tax rates will revert back to 2017 levels, and the estate tax exemption is going to revert back to where it was in 2017, indexed for inflation. So when we talk about creating a sense of urgency for clients, know that these changes are temporary. And of course, the one caveat we always throw in there, if there's any sort of change of administration at 1600 Pennsylvania Avenue, either Chamber of Congress, those changes can either be extended or shortened depending on how those play out. But what we know now is at the end of 2025, rates are going to come back down. That's going to lead to meaningful insurance planning opportunities. So let's talk about what some of the common strategies we're seeing utilized as a result of these changes, knowing the law is sunset. The biggest opportunity for permanent life insurance for individuals, which could also be incorporated to owners of pass-through tax entities like S corporations or LLCs because they are taxed as individuals, is really calling it tax diversification planning. The idea being is that these individuals are paying a lower effective income tax rate today and will be for the next 7.5 years, again, until the end of 2025. The idea we're positioning is leveraging that tax benefit today by taking lower effective after-tax dollars, putting it inside of an overfunded cash value life insurance policy, and funding it for the next 7 years. So when the law sunsets at the end of 2025 and income tax rates come back up, we've put as much money as we can into these individual life insurance policies that grows tax deferred. And because it's life insurance, we're able to access that money on an income tax-free basis. So when rates do increase in 2026, we're less concerned because we've created a tax-free bucket of money for long-term planning. The way I associate this, I grew up in the Midwest, I grew up in Iowa. The association I always make is let's pay tax on the seed and not on the harvest. And the idea of using a 7-pay really is twofold. Number one, it kind of aligns right with the ending duration of when the tax law is set to revert back to 2017 levels. But also for life insurance, cash value life insurance specifically, typically 7-pay scenarios tend to be some of the most efficient type of funding levels. We're talking about funding IUL, VUL, current assumption universal life products with the goal of cash accumulation. So we see this a lot for individuals who are maxing out qualified plan contributions, owners of an S corporation who are again struggling to find ways to do some tax efficiencies in retirement planning, or just individuals who again want to have that tax diversification strategy. When we think about tax diversification, a big part of it is looking at different asset classes and really how we're distributing those funds in later years. 401ks, annuities, mutual funds, stocks, all those are great assets, real estate, but at some point in time there's a taxation level to each one of those. What we're talking about is creating a tax-free bucket of money and leveraging lower effective after-tax dollars today in order to fund that. We've seen a significant amount of individuals and business owners utilize this 7-pay strategy to take advantage of lower income tax rates today. Along the lines of individual planning, we talked about the estate planning marketplace. And as I mentioned, a lot of clients now with the doubling of the exemption, where in 2017 may have had a tax liability, an estate tax liability, but now with the doubling of the exemption, they don't. Well, again, the phrase I use for a lot of clients is, that's great that you don't have an estate tax liability, but you better hope you die between now and 2025. Because again, remember what happens with the estate tax law. At the end of 2025, that exemption that's at 11.2 now, 22.4 for a married filing jointly couple, is going to be reverted back to 2017 levels, meaning it's going to get cut in half. So while they may not have an estate tax liability today, they may have one in 2025. So what we're able to do at Principal, and what makes us a little unique as an insurance carrier, is we are able to help that client at least lock in some insurability by buying term insurance and giving them the ability to convert that to a second to die policy down the road. So the idea behind this solution is if a client may have a future need for liquidity for estate tax planning, and what they can do is lock in their insurability by buying term insurance with Principal. The idea being is that they wait to 2025, maybe their insurability changes, maybe they will have an estate tax need, all those different things can come into play. What we allow them to do is actually allow a husband and wife to convert two term insurance policies into a second to die survivorship policy. And we do that at 2 times the face amount of the term insurance. So as an example, if you have a husband and wife who may need $10 million as survivorship at a future date, we would buy one $5 million policy on the husband, one $5 million term policy on the wife, and we can convert that to $10 million of survivorship, no underwriting up to age 70. So the idea is lock in their insurability, lock in that plan technique, give them some flexibility long-term, knowing that if the rates do come down, if the exemption does come down, that they at least have the insurance in place, so they're not worried about being uninsurable in 7 years. The key phrase that I've heard used quite regularly is tell your clients to plan as if the tax law has already sunset. If you talk to anyone who is plugged into like the Washington advocacy programs here within, whether it's Principal or other carriers, the common thing we hear is that we know it's going to sunset at least at 2025. The likelihood of a lot of these rates changing prior to is pretty high. So we're talking again about creating some flexibility inside of these planning techniques. And keep in mind, if you do have questions as we go along, feel free to type them in the chat section. We will have time at the end to address those specific questions. But as we move on, one of the key areas and where a lot of my focus tends to be is in the business insurance marketplace. And that goes back to a lot of the changes from a corporate tax perspective. And probably the biggest piece of this tax legislation that had the most meaningful impact was the corporate tax rate for C corporations. The corporate rate dropped from a top bracket of 35% to a flat 21%. There was also an elimination of the corporate alternative minimum tax. We'll talk about why that's important in just a moment. But the key difference between this piece of change and the individual and estate taxes is that this change is permanent. Now, if my compliance department would let me, I would put quotations around permanent, because as everyone knows on this phone, that if something is permanent in Washington, it's only permanent until somebody else changes it. But what we know now is that that 21% flat corporate tax rate is a permanent solution. In addition to that, when we're talking about S corporations or LLCs, any sort of pass-through tax entity, there was a 20% deduction that was added for quote-unquote qualified business income. That last bullet point is a 2-hour PowerPoint presentation in and of itself. If you ask any of our CPAs, any of our tax attorneys, they're saying that this one bullet point is the most complex piece of tax legislation they have ever seen. The bottom line is a lot of these S corporations, a lot of these LLCs that are pass-through tax entities have some ability to deduct qualified business income, which again is going to create more working capital for them as a business owner. Now, when we look at the corporate tax rates as a whole, whether you're an S corporation, whether you're an LLC, whether you're a C corporation, there was an overall reduction. What that means to business owners is, like with individuals, they're going to start seeing more cash on hand. As they're doing their quarterly filings, they're going to see more excess capital. Every year, Principal does a survey of hundreds of business owners that we call the Well-Being Index. And when we did this survey in 2017, one of the things that stuck out to me most, that at the end of August, when the survey was completed, 72% of business owners that we surveyed said they were sitting on surplus capital. So when we think about what this was prior to the Tax Cuts and Jobs Act, what companies are sitting on with surplus capital, think about a C corporation that just saw a 40% reduction in their corporate tax rate, going from 35% to 21%. The idea is we're going to have a lot more opportunity to start actually filling in some needs around business insurance planning because the cash is on hand. Let's talk about who you want to talk to from a business owner perspective. When I look at the most areas of success we're having in placing life insurance business currently, these are the top industries where we're having success. Number one is our construction-related businesses. Whether you're in the Pacific Northwest, whether you're in Southern California, whether you're in Florida, the Midwest, wherever you go, you're going to find infrastructure is growing with commercial building, residential building. All those businesses are booming right now. The challenge they have is updating business continuation planning and retaining top talent. They are really good fits for a lot of things we're going to talk about from a corporate planning perspective. In addition to that, we see a lot of family-owned businesses. If I could circle one here that'd be on the top of my list, family business planning tends to be a great opportunity because most of the solutions that we cover with business owners, family businesses have not implemented. And we especially look for those family businesses who may have non-family member key employees. They're great fits for non-qualified planning. C corporation owners. Owners of a C corporation benefited greatly from the changes to the Tax Cuts and Jobs Act. We'll talk about a very brief scenario of executive bonus plans and non-qualified plans that are really advantageous for owners of C corporations. In addition, we're also looking at professional, scientific, and technical service firms. These are your law firms, your CPA firms, your engineering, architecture, medical, and dental practices. Again, they saw some reduction in corporate tax rates depending on how they were structured. There was some limitations based on that qualified business income for law firms, CPA firms that may not have as much of an impact. So the timing right now is good to go out and talk to these folks as they're finishing up their 2017 returns. And lastly, manufacturing. The reason manufacturing is a great fit really is in the non-qualified planning space. The biggest reason is that typically with manufacturing, there's a large discrepancy of compensation between a management or executive team as well as the rank and file laborers working the lines. So we tend to find there's good opportunities to do non-qualified planning for those management teams. And as we look at the benefits here, we talk about non-qualified planning. It's really how do you reward and retain your top talent? And that need to recruit, reward, and retain top talent, regardless of what changes with corporate tax rates or overall tax rates, the need doesn't change for a business owner to protect what's most valuable in their organization, their people. What matters now is that some of these plans become more attractive to business owners in light of the changes in tax reform. The lower corporate rates that are, whether you're an S corporation or a C corporation, it lowers an employee's cost to implement most of these plans because we're using after-tax money to fund it. If I'm using after-tax money inside of a C corporation, rather than paying 35% of that money, I'm only paying 21%. It gives me more working capital to implement some of these ideas. The other area we're seeing a lot of success, and I touched on it very briefly, is working with owners of C corporations. Now, while the majority of business owners you're going to run across are S corporations or LLCs, for the C corporation owners you do come across, executive bonus plans are very attractive to those business owners. And the way an executive bonus plan works, it allows the owner of a C corporation on a discriminatory basis to bonus themselves additional compensation today out of the business and put it in an individually owned life insurance contract. They name their own beneficiary. They have all the flexibility of owning the policy personally. The benefit to doing this kind of program is that the business can gross that bonus up for taxes, so the owner is not coming out of pocket to pay the taxes. And the biggest benefit is the corporation also gets to deduct the entire value to the business. So it's a way for a business owner who owns a C corporation to bonus themselves out more money on a discriminatory basis, allow the business to essentially pay the taxes for them, and allow the business to deduct the entire value of that bonus as compensation. And more importantly, it's also pulling money out of the business, putting it as an individual asset, which does shield those dollars from business creditors. So it's a great way for an owner of a business to have some very meaningful tax efficiencies by pulling those monies out. And keep in mind, if we use life insurance as the funding mechanism, we have tax-deferred growth, and we have the ability to access that money on an income tax-free basis. We're seeing more and more C Corp owners leveraging this strategy. In addition to that, we do a lot of buy-sell planning. We are seeing more and more buy-sell agreements that are actually being funded not using term insurance, but being funded using some sort of cash value insurance policy. The idea being is that now with the elimination of the corporate alternative minimum tax, lower corporate rates, having cash value life insurance as an asset on the balance sheet becomes even more attractive. And the benefit to using cash value life insurance is that if the owner dies, there's still a death benefit to fund that buy-sell agreement. But the additional benefit is if they live having a cash value life insurance policy helps that create a living buyout. It creates a sinking fund of cash value that can help a business owner create some sort of non-qualified bucket to help them actually transition out of that business and provide them some sort of retirement income stream. So we're seeing more and more businesses get away from just using term insurance to fund their buy-sell agreements and looking at using some level of cash value life insurance because it does give them a lot more flexibility. And lastly, one of the opportunities for really executive benefits comes to owners of S corporations and LLCs. While they can't deduct bonus payments as compensation, that tax diversification story we shared earlier around 7-pay life insurance is very meaningful for them as well. Again, because S corporations and LLCs are taxed as individuals, that strategy of pulling money out in a tax-efficient way today with lower effective rates, putting it inside an overfunded cash value life insurance policy that grows tax deferred and you access on a tax advantage basis is a great conversation starter for those business owners, because a lot of these owners are still struggling to find ways on a tax efficient way to save money for retirement. So we are seeing more and more owners of S corporations and LLCs implement this specific strategy using that 7-pay technique. And again, as you have questions, feel free to throw them in that chat box on the window pane of your webinar. So as far as helping a business owner identify what some of these opportunities are, once you've identified there's a need to do key employee retention, non-qualified planning, here are the key questions we want to have you ask and get comfortable with asking to those business owners to figure out the right kind of plan that's going to make sense for them. So we have a wide range of options available for the business owner. First thing we always want to find out is what's the corporate tax structure for that business. Are they a C corporation? Are they an S corporation? Are they an LLC? So on and so forth. That's very important as you start looking at these kind of plans. In addition, we start talking about these non-qualified retention plans. Who's the plan really for? Is it for employees? Is it for owners? Is it for both? A lot of times we're having a conversation with the owner about a quote-unquote non-qualified plan. We find that it's really the owners trying to do something for themselves because maybe the employees aren't contributing to the 401k. He or she is struggling to put money away on a tax-efficient basis. Knowing who the plan is for helps us determine the right plan design. And lastly, we talk about employees. So if it's an employee you want to put a plan in place for to try and incentivize them and reward them as a part of the business, you want to ask the business owner what's more important. Is it control of the plan, or is it the current tax deduction? We have options that will give the business owner an upfront tax deduction, or if they want to control plan assets, they'll get their tax deduction down the road. And that's really where all of these different solutions come into play. And again, this is a 3-hour presentation in and of itself, this one slide. Just know that when it comes to key employee retention and reward tools, all these non-qualified plan techniques, no one does more of these than Principal Financial Group. We are the #1 provider of non-qualified plans in the industry. So whether it's trying to reward a top talent employee, whether it's trying to retain somebody long-term without making them an owner, we have a wide range of solutions. And now with all these changes in corporate and individual tax rates, these plans become more attractive to business owners to actually implement. And last but not least, before we open it up for additional questions, is we want to talk about what we do long-term. So Principal is, again, focused on the business insurance marketplace, whether it's access to our CPAs and attorneys on our staff, my team of business insurance specialists, product and underwriting, as well as the administration side. We've built a platform that helps you as an advisor from start to finish, not become the expert in the business marketplace, but be the relationship manager and allow us to be the expert in the marketplace. You have access to our CPAs and our attorneys to do, whether it's case consultation, conference calls with you, your client, and their CPA and attorney. You also have access to my team of specialists who do a lot of point of sale work, whether it's over the phone or in person. And then at Principal, we build our products and our underwriting around the business insurance platform. So our products are designed to work in the business insurance space. And last but not least, the service aspect of it. We have a dedicated team we call Business Markets Administration. And what our Business Markets Administration does is they record keep all these plans, from non-qualified plans to basic key person buy-sell agreements. We record keep over 18,000 business insurance plans. The idea being is that they're going to keep a pulse on all the tax law changes to make sure if there's anything that impacts a plan you have in place with Principal, we're able to communicate proactively to your clients on what the best course of action would be. So we want to make sure that we are there from start to finish. And all this comes to you because of your partnership with Core Group. You have access to all these resources and all the things that Allie and her team have brought to the table today. We want to make sure we're here to help you uncover great opportunities and help you every step along the way. So with that, I do want to open it up for questions. And while we do that, I want to make sure that everyone does have my contact information. As I mentioned, we will be sending out some follow-up content around this specific presentation, in addition to some ancillary content around very much more detailed information about these changes and where other opportunities are. So let's go ahead and compile a list of questions. And again, it's on your chat feature on your pane for your webinar. So feel free to throw in any questions. We're happy to answer them for you.
Hey, Paul, can you see that question that's up there now or no? I can read it to you.
Yeah, if you could read it to me, that'd be great.
Oh, sure, no problem. Melissa's asking, will you explain the income limits and phase out for the pass-through entities?
Yes, so there is a phase out and income limits. Off the top of my head, it's around $320,000 for the phase out for the qualified business income. All those details and the actual schedule of that will be in one of the content pieces we will send out. The key thing to remember is there was some exclusions to that qualified business income. Professional service organizations like law firms, CPA firms, financial service practices, they were excluded to a certain extent around some of these changes. So keep in mind that qualified business income, we will send out the schedule what the phase out is. You'll see that, but also know there is some exceptions to that particular piece of legislation as well.
Gary had a question about sending out the PowerPoint. The answer is yes, we will be sending out the PowerPoint after. Correct, Paul?
Yes, we will.
Okay. Another question we have is, what's the best way to start the conversation with a business owner, you know, about this topic? How do we kind of get that conversation going?
Yeah, and so what I would do a couple of different things. You know, one, and I'll send another piece too. It's kind of our client profile sheet in a little bit more detail to kind of help look at prospecting, where I typically will find a couple of different approaches. If it's an existing client, one of the things that I'm very keen about, you know, bringing up to an existing client is, hey, I was listening to this webinar and they were talking about, you know, successful business planning techniques, and I immediately thought of you as my client, and I want to sit down and have a conversation with you. In addition to that, one of the key things that I'm hearing from business owners, they want to talk more about retaining top talent. So my big question that I go to with business owners is sitting down and thinking, you know, one of the key areas where I help business owners is making sure that if you have key employees in your organization, that we can help you retain and reward that top talent. We want to sit down and have a discussion about how we can help you retain your best employees. That tends to kind of lead in a better door opener. Or a big thing of it is right now, with timing, it's tax time. You know, you probably just finished up your individual or your corporate returns. You know, there's a lot of things that changed with the new tax law. I'd love to sit down with you and talk about some different planning techniques that we've seen other successful business owners implement.
And I have one other question. Do you have simplified or guaranteed issue underwriting for this? We
do. We have both. So we have a simplified issue program as well as a guaranteed issue program. Simplified issue is down to as few as 5 lives. Our guaranteed issue platform is as small as 10 lives, and it's all formula-based, face amount times the number of lives in the group. And that's available on any one of our products outside of our term insurance. So term insurance is unavailable, but any one of our other products is available for guaranteed issue.
Great. Thank you so much, Paul. I think that's all I have as far as questions go. So we might be able to wrap up right on time. We appreciate you doing this for us so much.
Yeah, I want to thank everyone for taking time out of your day. Again, all my contact information is here. Of course, contact your folks at CORE as well. Happy to answer any questions, discuss any opportunities, and look forward to continuing to build some momentum. So thank you, everybody, and have a great day.
Have a great one. Thank you.